morning, everybody. My name is Amber Hines, and I want to thank you all for taking time out of your schedule today to join us. Today, we're going to be talking about Medicaid basics and understanding the asset and income rules in each of your states. I hope all of you are staying well based on the current environment, and I want to tell you that if you have questions throughout the webinar, feel free to type those into the questions tab of the GoToWebinar dashboard. Also, if you're interested in a copy of the materials from today's webinar, you can download those by going to the handout portion of the GoToWebinar dashboard. You can download those there. Otherwise, if you reach out to me afterwards, I'd be happy to email those out to you as well. Again, my name is Amber Hines. Some of you may know me by my maiden name of Amber Gwynn. I have worked with elder law and estate planning law firms across the country for the last 15 years to assist with Medicaid compliant annuities and Medicaid crisis planning. I'm insurance licensed in all 50 states, and I hold a Series 65 license with FINRA as well. I created Ashper. I'm the founder of Ashper to assist advisors and attorneys with pre-planning solutions as well as crisis planning for their clients. One thing that makes our company different from others is that we only work with A-rated insurance carriers when we're offering Medicaid compliant annuities, which can be something that provides your clients with comfort, especially based on the current financial environment that we're in. If we start out with basic information as far as ways to pay for long-term care, clients have the option to simply privately pay or self-insure. So this would mean basically spending down dollar for dollar their assets, whether it be retirement accounts, checking, savings, investment accounts, and they can privately pay out of their existing funds if they choose to do so. We can also look at long-term care insurance, whether it be traditional or a hybrid policy. Those are two distinct types of long-term care insurance. Traditional is going to be similar to a client's homeowners or auto insurance, where there is no cash value associated to the policy. It's simply going to pay if there is a long-term care event, whereas a hybrid policy is going to be combining either a life insurance policy or an annuity policy with a long-term care rider. So those policies do have cash value, and they also have a death benefit if the policy is never used for long-term care purposes. We also can look at veterans aided attendance benefits if we're dealing with a client that is a veteran or a surviving spouse of a veteran that served at least 90 days of active duty with 1 day during a period of war. Finally, we can look at Medicaid planning, which is what we're going to be talking mostly about today. So Medicaid, what is it? Medicaid is a jointly funded federal state health insurance program for low income and needy individuals. Medicaid covers children, the aged, blind, and other disabled people who are eligible to receive federally assisted income maintenance payments. With most of you on this call today being either estate planning or elder law attorneys, you're mostly going to be dealing with clients that are meeting the age requirement or the disability requirement when we're looking at Medicaid qualification. Medicaid is based on federal law. States interpret and administer the federal law. And although Medicaid is based on federal law, Medicaid rules vary from state to state, and in some states, it's even county by county. So when I work with a law firm in Pennsylvania or New Jersey, those are two states that are very county by county, where one county will assess a client's case one way, and another county that's one county over or across the state will assess the case completely different. When we look at the differences between Medicaid and Medicare, there's a lot of confusion, especially if you're just getting into this area of law. A lot of people confuse the two, Medicare and Medicaid, but Medicare is going to be a program that is a health insurance program for individuals that are 65 or older. there is no asset or income requirements for Medicare. So that's something to keep in mind when you're talking to clients and when you're just looking at the different ways that we can pay for long-term care. Medicare is only going to cover a very short period of time in a nursing home as far as assisting with the cost of care, whereas Medicaid is really going to be the payer that is going to assist with long-term healthcare costs across the country. So Medicaid planning, what does Medicaid planning mean? It involves spending down or otherwise protecting a person's assets so that he or she can meet the financial criteria for Medicaid qualification. Medicaid planning can be divided into two different types. There's pre-planning and there's crisis planning. Pre-planning or proactive planning for long-term care involves somebody that is pretty healthy at this point. They're not in need of any immediate long-term care services, nor are we anticipating that they're going to need long-term care for some time. Pre-planning is always going to be our best option because it gives the client the most options to preserve their assets and to stay in control of their assets and choose how they want to protect their assets and still be able to qualify for or pay for long-term care down the line. From a legal standpoint, pre-planning generally involves transferring assets into an irrevocable trust and waiting out the current 5-year look-back period that Medicaid has for transferring assets. From an insurance standpoint, pre-planning may also involve purchasing long-term care insurance, whether it be a traditional policy like I talked about or a hybrid policy. The main thing to note here is that if we're going to look into long-term care insurance for clients, they still have to be healthy enough to qualify. So they will still need to pass an underwriting, the underwriting involved with a long-term care insurance policy. Whereas if we look at crisis planning, this is going to involve somebody who is already in need of assistance with activities of daily living, or we anticipate them needing long-term care services very soon. So somebody who is considered to be in crisis mode is no longer going to qualify for a long-term care insurance policy, nor would it be somebody that we would typically be recommending that we start transferring assets into a trust, because that's going to trigger a 5-year look-back period for Medicaid. So there's various planning strategies that we can use when we're dealing with a crisis planning scenario where somebody is already in a facility looking to qualify for long-term care, or we anticipate them entering that phase, and we would be looking at basically converting countable assets that Medicaid says are countable into exempt or non-countable assets, which is really what our focus of today's webinar is going to be talking about. We look at the basic Medicaid eligibility requirements. There, as you can imagine, are non-financial and financial requirements in order for somebody to qualify for a government assistance program like Medicaid. So on the non-financial side, we need an individual that is a US citizen or a qualified alien, and they also must be either 65 years of age or have been deemed disabled. On the financial side of things, we're looking at somebody that has limited assets and limited income. So what exactly does limited income and assets mean? Well, it depends if we are dealing with an individual client or clients that are married. If we're dealing with an individual that does not have a spouse, the income limitation for an individual client is going to be that their income must be less than their cost of care. The average cost of 1 month in a nursing home is around $9,000 per month. So if you imagine somebody needing to meet that income requirement, that's typically not all that challenging based on most of our clients having limited Social Security income, and maybe if they have a pension that can help pay for that. There are some states that impose an income cap, which we're going to be talking about. And in those states, we would need to look into a qualified income trust or a Miller trust. From an asset standpoint, for an individual client that does not have a spouse, generally the person can keep no more than $2,000 of liquid assets. There are some states that that number is slightly more, and some states that that number is slightly less, but As far as across the country, $2,000 is the most common number that we see when we're looking at countable assets for an individual. So throughout today's webinar, I'm going to be referring to the $2,000 asset limit. But if you're in a state like Missouri, that limit is going to be $4,000. In a state like New York, that number is close to $20,000 that an individual can keep. A married couple, if we're looking at the income and asset limitations for a married couple, again, the institutionalized spouse's income must be less than the cost of care, and the community spouse can have unlimited monthly income. From an asset standpoint, a married couple, the institutionalized spouse is going to be able to keep no more than $2,000, and a community spouse is entitled to 1/2 of the couple's resources up to $128,640. This is going to be something that we're going to spend a lot of time on figuring out what your state does as far as how much the community spouse is able to keep. We're first going to look at the income aspect of Medicaid qualification. So if we look at how income is defined for Medicaid, this is going to include gross income from all sources. So earned income, if the person is still working and they have wages or self-employment income, that is going to be considered countable income for Medicaid. We also are looking at unearned income, so income from all other sources other than employment. And this is going to include Social Security income, retirement income, pension, support, annuity payments, maintenance, disability insurance payments, and Social Security disability income. If we look at a married couple situation and we're trying to determine whose income is who, we have to look at the name on the check rule. So basically, the income is going to count to the person whose name is on the check. And if there's 2 names that show up on the check, then the income is going to be allocated equally. For income purposes, states are either going to be a spend down state or an income cap state. If you refer to the map that you're seeing on the screen right now, you can see that the spend down states are going to be the ones that are in white, and the income cap states are going to be the states that are showing up in orange. So a spend down state is a state which the spend down amount is the amount that must be contributed towards the cost of care after income allowances and exemptions have been deducted. So if we look at an example of a client that has income of $1,000, but the eligibility requirements only allow for income of $800, the client must incur an additional $200 in allowable expenses before qualifying for Medicaid. So again, this is not going to be a hard threshold to hurdle as far as being a spend down state, because most clients, if they are in a long-term care situation, they're spending way more than what they have in income. If we look at an income cap state is a state that imposes a limit on the Medicaid applicant's income. The monthly income cap for the year 2020 is currently $2,349 per month in gross income. Any income that is over that cap amount of $2,349 must go into a qualified income trust or a Miller trust before paying the nursing home. An example of an income cap state would be if we had a Medicaid applicant who receives $2,500 in monthly income, but the cap amount is $2,349. The applicant would not qualify for benefits because her income is over the cap amount of they're over by $151 more than what the state income eligibility rules allow for. However, if we establish a Miller trust and the extra income of $151 is deposited into the Miller trust account, then we're able to meet the income cap amount, and this individual would be considered eligible for Medicaid. Usually all of the applicants' total monthly income, whether it be Social Security, pension, annuity payments, will be deposited into the Miller Trust if possible. And we do this to avoid there being an accounting error as far as more income being deposited into the client's account versus into the Miller Trust account, and which would make them ineligible for Medicaid. So just know that in most cases, we're trying to funnel all of the income that the client has through the Miller Trust so that we're not right on the edge of the person qualifying for Medicaid. A qualified income trust or a Miller Trust, we use those terms interchangeably. So if you hear me say one or the other, it means the same thing. It's an irrevocable income only trust, which holds the excess income of a Medicaid applicant so that they meet the allowable income limitation in an income cap state. So if you are in a non-income cap state, there would be no reason that you would have to set up a QIT or a Miller Trust. But if you are in an income cap state, then a Miller Trust is going to be designed to consist solely of pension, Social Security, and any other income that the client has, plus any accumulated interest. The funds remaining in the trust must be spent on the applicant's care. And also any money that is left in the trust after the Medicaid applicant dies will first be used to repay the state Medicaid agency for the amount that they provided in benefits. When we look at income for a married couple, as I said before, the institutionalized spouse's income must be less than his or her cost of care. The community spouse is entitled to unlimited monthly income. However, if the community spouse does not have enough of his or her own monthly income to meet their monthly maintenance needs allowance, they're going to receive a portion of the institutionalized spouse's income. Any income that's remaining after we shift income to the community spouse under the MMNA requirements are going to go towards the institutionalized spouse's cost of care. So there's a lot of acronyms that are going to be used throughout the webinar today, but know that the monthly maintenance needs allowance only applies from an income standpoint, and this is going to allow the community spouse to have a minimum amount of income, and if they don't have that income, if the community spouse does not have enough income to meet their monthly maintenance needs allowance, then they're going to receive some of the institutionalized spouse's income under these rules. So how do we calculate the monthly maintenance needs allowance, or what does it mean? This is the minimum amount of income that the community spouse is entitled to when we have the institutionalized spouse applying for Medicaid. So some states are going to have a standard MMNA amount, and then other states are going to apply a minimum and a maximum amount. This is generally going to range between $2,114 per month and $3,216 per month. I want to emphasize that the monthly maintenance needs allowance is not a maximum amount of income that the community spouse can have. This is a really common misconception that people believe that the community spouse, that their income is based on a limited amount, but the monthly maintenance needs allowance is the amount that can be shifted from the person in the facility over to the community spouse so that the community spouse does not become impoverished in that, so that they have enough income to live on to pay their expenses when they remain at home. You're seeing a map here of all of the states as far as whether they're going to apply a standard monthly maintenance needs allowance or if they're considered to be a minimum or maximum state. All of the states that are in blue are considered minimum maximum states, and the states that are in orange are going to be standard monthly maintenance needs allowance states. If you're looking on our website, we have all of the updated figures as far as what your state does from an income standpoint and from an asset standpoint. So if you go to www.ashford.com and you click on the tools and resources tab, you will click on your state and it will tell you whether your state is a min-max state or if it's a standard state amount. So if you're looking at the resources for your state and it comes up that there's only one number, the maximum monthly maintenance needs allowance, then your state is a standard state where the community spouse is entitled to a minimum amount of income of $3,216 per month. However, if you look at the tools and resources tab on our website and you see that your state has two different numbers listed, they have a minimum amount of $2,114 and then they have a maximum amount of $3,216, then you know that you're in a min-max state where it can be a combination of the two, or you're able to get a variation of the maximum. So we're going to look at a married couple example, an income example dealing with Robert and Nancy. This is based on Robert and Nancy being married. Robert is about to enter a nursing home and Nancy is going to remain at home. Robert has monthly income of $2,500 per month. Nancy's income is $1,216 per month. Their state rules say that Nancy is entitled to the maximum monthly maintenance needs allowance at $3,216 each month. So we see by taking the monthly maintenance needs allowance that Nancy would be entitled to at $3,216, and we subtract out Nancy's income at $1,216, she has a shortfall each month at $2,000. So she needs additional income based on her state rules that will allow her to receive some of Robert's income to make up for the fact that she doesn't have enough income on her own. So her state will divert $2,000 of Robert's income over to Nancy, which leaves $450 of Robert's income going towards the nursing home. You're looking at the calculations here. So first we would determine what Nancy's income is. And we told you that her income is $1,216 per month. Next, we need to determine if there is a shortfall between the monthly maintenance needs allowance and her current income. We know that with the monthly maintenance needs allowance in her state being $3,216 and her income being $1,216, she has a shortfall of $2,000. So we're going to look to Robert's income in this example, where he has $2,500 of monthly income. We then deduct the $2,000 that Nancy is short each month and a $50 monthly personal needs allowance that Robert would be entitled to determine that his copay, or the money that is left that he has in his name, is going to go towards his cost of care. So that's how we're calculating the $450 monthly copay or patient liability that Robert would contribute towards his care. If we move on to looking at an example where instead of the maximum amount of the maximum monthly maintenance needs allowance that Nancy would be entitled to in the previous example, we're now looking at a state that would have a minimum monthly maintenance needs allowance at $2,114 per month. In this example, Nancy would only be entitled to $898 of Robert's income each month. If Nancy is able to show that she has excess shelter expenses like a mortgage, utility bills, etc., then she could receive more of Robert's income up to the maximum of $3,216 per month. So the numbers work out to be similar as far as the steps that we go through in a minimum monthly maintenance needs allowance example, where the income numbers for Nancy are going to be unchanged at $1,216 per month. But we see that the monthly maintenance needs allowance is now only $2,114 per month. So her shortfall is going to be significantly less than the previous example. Her shortfall in this case is only $898 per month. So that's the amount that she is going to receive from Robert. Robert's income remains unchanged at $2,500, and we are going to subtract the amount that gets shifted over to Nancy at $898, and also subtract out the monthly personal needs allowance at $50, so that Robert's copay in this example is $1,552. So you'll notice that as we're able to shift less money over to the community spouse under the monthly maintenance needs allowance calculation, the copay to the nursing home is going to increase because we're not getting as much income over to the community spouse as we could in this minimum example as we could when Nancy was entitled to the maximum MMNA. So how do we determine the monthly maintenance needs allowance in a minimum maximum state? So the community spouse is going to be entitled to a minimum monthly maintenance needs allowance, like we just talked about, the $2,114 per month, plus excess shelter allowances, but this number is not to exceed the maximum monthly maintenance needs allowance. So excess shelter expenses can be added to the state shelter standard, and if there is a remainder amount, then that amount is going to be added to the minimum monthly maintenance needs allowance. So we would be looking at how much the community spouse is spending on rent, a mortgage. The mortgage is going to include principal and interest, any taxes and insurance that are paid on the principal place of residence. This is also going to include renter's insurance, any required maintenance fee that the community spouse would pay for a condominium. And then also we're going to add the standard utility allowance established under the state Medicaid program. That's also a number that can be found on our website as well. So all of these figures are going to be added together, and then the state shelter standard is deducted from the remaining value. And if that number is a positive number, then we're going to add that to the minimum monthly maintenance needs allowance. So for example, if we have a client that's spending a lot of money on their mortgage or a lot of money on rent, if we have a community spouse that is in assisted living themselves and they're not looking to qualify for Medicaid, but they have very high shelter expenses, then we can get more money shifted over to the community spouse under these monthly maintenance needs allowance numbers. So it's important to look at how much the community spouse needs if you're in a min-max state, because you can increase the minimum monthly maintenance needs allowance to a greater number if we can establish that the community spouse has these additional costs that they need to help pay for. If we look at the married couple example where we were talking about Robert having $2,500 of monthly income in his name, and we were shifting income over to Nancy under the monthly maintenance needs allowance, if we were dealing with clients that were in an income cap state, we would need to establish a qualified income trust or a Miller trust, because Robert's income of $2,500 exceeds the current cap amount at $2,329 per month. So that's an important thing to remember if you live in an income cap state, is the gross income of the person that's applying for Medicaid. Even if we're going to shift income over to the community spouse under the monthly maintenance needs allowance calculations, you may still require the qualified income trust or the Miller trust in order to establish eligibility for Robert in this case. Okay, so now we're going to move on to the asset portion of the webinar. So everything that we've done so far is only dealing with income for a married couple, and an individual client that would be applying for Medicaid. Now we're going to move on to the asset portion, and you'll hear even more acronyms, which are always fun. So for Medicaid planning purposes, assets are either going to be countable or non-exempt, or they're going to be protected, exempt, or non-countable. All of these terms can be used interchangeably. So if I say that we're dealing with a non-exempt resource, that's the same thing as a countable resource, or if I say an exempt resource, that's going to be the same thing as a protected resource or a non-countable resource for Medicaid. So a countable or non-exempt resource is going to be assets that are counted towards Medicaid asset limitations, whereas a protected resource or an exempt resource is going to be assets that are not counted towards Medicaid asset limitations. If we look at an example or examples of assets that Medicaid is going to deem countable, or they're going to count towards the asset limitations, we're looking at accounts like checking accounts, investment accounts, CDs, cash, IRAs in some states. In other states, IRAs are going to be exempt. Also, real property outside of the client's primary residence. So if they have a vacation home or a second home, that is going to be a countable asset. And then also boats and RVs are also going to be countable assets. Protected assets or exempt non-countable assets are going to include the home, automobile, household goods and personal property, an irrevocable funeral trust or a prepaid burial. And again, IRAs in some states are going to be protected, and in other states they're not protected. So if you have questions about whether your state protects IRAs or exempts those from qualification, feel free to reach out to me and I'd be happy to help you with that. We look at how to calculate the community spouse resource allowance. The community spouse resource allowance is the amount of resources that a community spouse is able to keep when the institutionalized spouse applies for Medicaid. Again, like the monthly maintenance needs allowance calculations, some states are going to apply one standard amount or the maximum, and other states are going to apply a minimum and a maximum amount, generally between $25,728 and $128,640. The couple's total assets as of the snapshot date or the first continuous period of institutionalization are going to be divided by 2 while still staying between the minimum and maximum amounts. So that's confusing, and we're going to be going through examples of how you calculate the community spouse resource allowance if you're in a minimum maximum state. Here is a map of how states look at the community spouse resource allowance, whether you are in a maximum state or a minimum maximum state. The states that are in orange on the screen are maximum states, whereas the states that are in blue are a minimum maximum state. So as you can see, most states across the country are going to be a minimum maximum state. So that's where we're going to spend most of our time. Again, if you look at our website to figure out what your state does, you'll see that if you're looking at the resources tab on our website and your state only has one number under the resource or the asset figures of $128,640, you know that you're in a maximum state. Whereas if you look at our website and you figure out that it has 2 numbers listed, the $25,728 and $128,640, you'll know that you're in a minimum maximum state because there's 2 numbers that are listed there. Again, we're going to look at an example dealing with Robert and Nancy, but this time we're going to be calculate the community spouse resource allowance. In our case facts here, we have Robert that owns the following assets. He has $25,000 in a checking account and $100,000 in mutual funds, whereas Nancy who's the community spouse, has $25,000 in a checking account and stocks of $50,000. So for the sake of this example, it really doesn't matter who owns these assets or if they had accounts that were jointly owned. They're all going to be taken into consideration for Medicaid qualification purposes, because we're not getting into whether they have qualified accounts or IRA accounts. We're keeping this pretty simple, where these are all after-tax dollars, so they could be joint or they could be owned individually. But if we add up all of the accounts that you're seeing on the screen, the couple has $200,000 of countable resources, and they're all non-IRA bank accounts that they own. So if we were using Robert and Nancy's assets and we were trying to calculate the community spouse resource allowance in a state that allows for the maximum community spouse resource allowance, we would be trying to determine how much Robert and Nancy can keep of the $200,000. So Robert, as the institutionalized spouse, is going to be entitled to keep his personal property, a prepaid funeral plan, and $2,000 of the $200,000 of cash assets. Whereas Nancy, the community spouse, is going to be able to keep the home, car, a prepaid funeral policy, her personal property, and $128,640 of the $200,000. So we see when we add the $2,000 that Robert can keep and the $128,640 that Nancy is entitled to keep, this couple has to spend down $69,360 before Robert is going to be eligible for Medicaid. So you're going to be taking the total resources of $200,000 and subtracting the protected resources of $130,640 to determine how many resources they need to spend down before we can meet the asset limitations for Robert to qualify. If we were dealing with an example where we were working in a maximum state and the community spouse was entitled to $128,640, and this couple only had $100,000 of joint assets, we could simply transfer the full $100,000 over to Nancy. And because she is under the asset limitation in her state of $128,640, Robert would be immediately eligible for Medicaid. There won't be a need to do any kind of spend down in a state where the community spouse is entitled to the maximum amount and they are under the maximum amount of $128,640. There is no penalty for transferring assets between spouses. So if in my example they had $100,000 of joint assets, or if most of that money was in Robert's name, you could transfer that over to Nancy and immediately get Robert on Medicaid because she's under the asset limitation in this example. If we're going to look at, instead of calculating the community spouse resource allowance in a maximum state, we're going to look at calculating it in a minimum maximum state. The 2020 CSRA numbers are going to range anywhere from $25,742 up to the maximum of $128,640. So in this example, we're going to take their total assets of $200,000 and divide by 2. We figure out that that number is $100,000. So the community spouse resource allowance in this case is going to become $100,000, and the community spouse must spend down $98,000 before Robert can qualify. We determine the $98,000 in this example by calculating the amount that Robert and Nancy can keep. You see that Robert is still only entitled to $2,000 of resources in his name, whereas Nancy is entitled to $100,000 of the $200,000 because we're in a minimum maximum state now. We're not just looking at a maximum amount of $128,640. So their spend down amount is going to increase in this example because Nancy is entitled to 1/2 of the resources up to the $128,640. So it's going to be $100,000 that Nancy can keep in this scenario. So they need to spend down more money, the $98,000 in this case. What if their total assets were $300,000 instead of $200,000? Well, now we're going to look at taking the $300,000 and dividing by 2, and we know that that number is going to equal $150,000. $150,000 is going to be greater than the current maximum at $128,640. So we know that the community spouse is capped at $128,640 because half of the assets are more than the maximum. So in this case, we see that Robert, again, is only entitled to the $2,000 of resources. That doesn't change. Nancy is going to be entitled to $128,640 of the $300,000. So they have to spend down $169,360 before Robert is eligible for Medicaid. This chart on this slide shows you if you live in a minimum maximum state and you get confused with the 1/2 number of the total countable resources, you can see that if the total countable assets of the couple is greater than $257,280, then we know that the community spouse's CSRA amount is going to be set at the maximum of $128,640, and the institutionalized spouse is going to be able to keep $2,000. So the very right-hand column is going to show what the total asset or the total protected assets of the couple is going to be by adding the Medicaid applicant and the community spouse's protected assets. The gray row is showing you that if you have a client that has less than $257,280, but they have greater than $51,456, then the couple is entitled to half of the total assets. So this is going to be similar to my example of the $200,000 of total assets. The community spouse was entitled to $100,000. And then when we add the $100,000 plus the $2,000 that the Medicaid applicant can keep, that's going to be the total protected resources that you're seeing in the very right-hand column. And then finally, the blue row is showing us that if the client has, or the married couple has $51,456 or less in resources, then the community spouse is going to be entitled to the minimum amount of $25,728. And then also adding the Medicaid applicant's $2,000 is going to get us to the $27,728 number. A common misconception with the community spouse resource allowance, like I mentioned, is that many people think that if there are assets that are in the institutionalized spouse's name, when the first continuous period of institutionalization is established, that we can't transfer the asset from the institutionalized spouse over to the community spouse. But that is not true at all. We can transfer assets between the community spouse and the institutionalized spouse without any kind of penalty by Medicaid. So there are no transfer penalties for transferring resources between the community spouse and the institutionalized spouse. What if your Medicaid client has excess resources? Then we need to develop a Medicaid eligibility plan, and this can include spending down or converting countable resources into non-countable resources so we can make improvements or increase non-countable assets, like making improvements to the home, purchasing a new car. Anything that is a non-countable resource, we can improve those assets in order to spend down the client's excess resources and get them eligible for Medicaid. We can also purchase prepaid burial policies or pay off credit cards, mortgages, and other debt. And then finally, we can consider exempt transfers. Some of the exempt transfers or non-penalized transfers when we're looking at spending a client down are going to include transferring the home to a spouse, minor or disabled child, or a child that has been residing in the home for the prior 2 years. We can also consider transferring assets to certain types of trusts that are not going to be penalized for Medicaid. Also, we can consider using a promissory note that has Medicaid qualifying language, as well as an annuity that has Medicaid qualifying language. On your screen now, you're seeing all of the requirements that are necessary in order for an annuity to contain the language that must be contained within an annuity so that it is not considered a penalized transfer. The annuity must be completely irrevocable, non-assignable, actuarially sound. It must make equal payments, and it must name the state Medicaid agency only to the extent that they have provided Medicaid benefits as the remainder beneficiary. So if you're ever looking at purchasing an annuity or using an annuity to spend down clients' excess resources, it's very important to know that there's less than 10 insurance companies across the country that offer this specific type of annuity contract, because it must contain all of the language that you're seeing on the screen here in order for this to be a non-penalized transfer for Medicaid. Some of the planning opportunities when we're dealing with individual clients that are only entitled to keep $2,000 or less in resources are going to include a gift and annuity strategy, a gift and promissory note, or a gift and partial returns. We can also consider a standalone annuity or a promissory note. If you're interested in learning more about any of these planning techniques, you can look at our webinar from February where we talked about planning for an individual client, and it goes through a detailed look at the different calculations that we go through in order to determine how much we can gift and how much we would put into an annuity or a promissory note in order to qualify the person for Medicaid as quickly as possible. Some of the planning opportunities when we're dealing with a married couple include using a Medicaid compliant annuity, using a promissory note, a CSRA expansion, so getting the state to increase the maximum amount that the community spouse is able to keep. And then some states do still allow for spousal refusal or for sole benefit trusts. Spousal refusal is going to basically include the community spouse basically refusing to pay for the institutionalized spouse's cost of care. And so these are all different planning techniques that we can use when we're dealing with a married couple. And if you're interested in learning more about the Medicaid compliant annuity used in a married couple situation, we did a webinar on this in January, which you can access on our website as well. So next month, we're going to be talking in more detail on these topics. So we're going to have attorney Todd Watley from Arkansas. He's going to be our guest speaker next month. That's going to be talking about exempt transfers in more detail. Todd is a certified elder law attorney with over 20 years of experience as an attorney. He's a past president of the National Elder Law Foundation and the ABA approved organization to certify attorneys nationally as certified elder law attorneys. And Todd has created, managed, and sold 3 law firms in Arkansas. So he also works of counsel for a number of law firms across the country, and he's a national speaker and educator on elder law issues. So if you're interested in learning more about the topics that I just mentioned, be sure to join us next month on May 13th at the same time, where Todd's going to be talking in more detail about all of these topics. Why should you choose to work with me and with Ashper? We have 15 years of experience working with elder law attorneys across the country to secure Medicaid eligibility for their clients. We offer complimentary case analysis, so we'll help you determine the optimal annuity amount, the term that your client could consider, and which assets should be annuitized. Keep in mind that every single case that we are contacted about is not necessarily a case that an annuity makes sense for. So we would be looking at all options for clients, and if an annuity doesn't make sense, we would be sure to tell you that we're not going to sell an annuity to a client that it doesn't make sense for. We do only work with A-rated insurance carriers for our Medicaid compliant annuities, and we can offer annuities as short as 2 months. And we offer top-notch customer service. So we get back to you usually same day if you have any questions about a case analysis, or if you want us to take a look at a situation that you're working on. We, in most cases, are able to get back to you the same day. And now I would like to open the webinar to see if there are any questions for me. You're seeing my contact information on the bottom of the screen. You can contact me through phone or email by using either one of the phone number or the email addresses that you see listed there. Okay, we have a question here about what is the divestment penalty divisor. So we actually did not touch on that today, but basically the divestment penalty divisor is a number that the state uses and considers to be the average cost of 1 month in a nursing home. And that is also a number that would be published on our website for each state across the country. And that number is used to determine how long the client would need to privately pay if they have made uncompensated transfers. So if the client has made, excuse me, gifts of, let's just say $100,000 in the last 5 years, you would be dividing the $100,000 by what your state considers to be the average cost of 1 month in a nursing home, and that is going to tell you how long the client would need to privately pay before they are eligible for Medicaid. Okay, we have a comment here that some states require that all income go into the Miller Trust. That we have a comment saying that is not right, but it's a rule that their state requires that all the income go through the trust. Okay, and then other questions here are state specific that I think would be helpful if I send you an individual email addressing the question. So I will respond to the rest of these questions through email this afternoon. But I want to thank everybody for joining us today. And again, be sure to register for our May 13th webinar, the same time at 11 o'clock Central. And again, I thank you for being here with me. If you have any questions, feel free to reach out to me directly. And I hope everybody stays healthy and well. Thank you.